It's the Brad and John Show.
The Brad and John Show. Today's date is April 8th. It is Election Day in the state of Missouri, and this is B Block, which means we started just around 7:20, but we're late this morning. Okay, John, yesterday, supposedly, and do you follow Jim Cramer?
No, but enough people retweet him that I see things like over the weekend him tweeting that yesterday would be Black Monday.
Yes, that's specifically what I want to talk about. And I'm thinking to myself, okay, the interesting part of yesterday was at one point in time, I think the stock market had a 2,000-point swing. At one point, it was down.
Yeah, it was yesterday. Yeah, well, that was based on rumors. Should we talk about that real quick?
Well, yeah, it was at one point it's down like 1,500 points, and another point it was up like 500. Wasn't that the deal?
Yeah. So we see, and again, none of this is financial advice, but when you see big swings in price, that's called volatility. So for a guy who listens every day to a volatility manager, a guy named Keith McCullough at Hedgeye, we've seen volatility spike in the last month or so, Brad. So those kind of indicators front run what's going to happen. So when you've seen a drawdown in the stock market like you've had an increase in volatility. In other words, moves up are going to be very high. You're going to have big bounces. And then the moves down are also going to be big. It's just called volatility. It's a mathematical fact. It's not an opinion. So it can be exacerbated by things like yesterday, the rumor that Trump was going to pause a trade war. So people who've lost a lot of money, Brad, think about the psychology of one of the folks that you referenced, like somebody that claims, I've lost 20% of my 401k. I'm going to start paying attention to my money now. And then they hear that Trump is going to pause the tariffs. So they think it'd be a good idea to dump a bunch of money into the market and buy stocks. So then the stock market shoots up. And then the functions that actually control the price and volume of stocks, which are giant algorithmic traders like BlackRock and others, they see the spike and then they sell on the gain and then the stock market goes down. So I don't mean to oversimplify it here, Brad, but you have a lot of people that are trading emotionally, which leads to the algorithms reacting. And then you just have an increase in volatility. Keith McCullough at Hedgeye, and the Hedgeye Investment Summit is free to everyone. And it begins today at 10 a.m., by the way. You can go to hedgeye.com and find it. I'm a subscriber, so I'll get a notification about it. But as Keith McCullough says, when you're in this area of volatility, he calls it the F bucket, and he uses a bad word on the macro show. In other words, Brad, this is not an investable time in the stock market if you're looking to jump in and jump out because volatility is too high.
Well, but part of it has to do with the fact, and this is, and I understand people get upset about stuff like this, but they say, oh, yesterday I lost so much money in the stock market. My 401k's gone way down. They didn't lose any money because unless they sold, they lost money. Because
you're saying it's a paper loss.
Well, it's not even a paper loss because of the fact that you have not. It's to the point where this is to me always the interesting thing. If the stock market's at 10,000 and you buy, let's say you buy an index fund, you buy the Dow Jones 500. Isn't there a Dow Jones
example? Yeah, a terrible slack-jawed example. Thank you.
Okay, but let's say there's which believe it or not was created by Rex Sinquefield. You know that.
Okay, let's go.
Okay.
Okay. No, he didn't invent the Dow Jones, but go ahead.
He
invented index funds. Go ahead.
Index funds. Okay. So the market's at 10,000, okay, and you buy into the index fund, and then it hits 20,000, and you go, oh my God, I just made.
And then it goes down to 18. You didn't lose any money because you're still ahead.
But my point is, if you sell at 20,000, you're the smartest guy in the room, okay. But yet, if you buy in at 10,000 and the market goes to 8,000, oh my God, I lost everything. It's like you're going to get tired of this. I give the example of Susie Orman talking about back in 2008, saying if you're upside down in your house, okay. I know successful real estate investors who told me that back in 2008, 2009, 2010, it was like a smorgasbord for them. They were buying property, they were buying houses, and what do the flippers want? What do the guys who are we buy ugly houses want? They want motivated sellers. Motivated sellers are people who are like, oh my God. First off, people going through divorce. Sometimes it's unfortunately it's probate. It's issues where mom and dad died and the kids got the house and they hated the house growing up in that house. They just want to get rid of it. They're dumping things. Okay. So the problem is, to me, if I had money, I'd be buying stocks that are getting beat up. I told you my goofy story about after I sold my business. I had $100,000 in the bank, and I went to my broker, a new broker at Schwab, and I said, I want to take my $100,000. I want to buy 100,000 shares of TWA.
And he brought his manager in, and what did the manager say?
Man, we can't allow you to do that. And he about pooped in his pants. And that was when TWA was still in business. They were going up and down.
Yep.
They'd been through bankruptcy. Within 2 months, the stock was at $6. I would have made $500,000. But yet, oh no, can't do that. TWA is in bad shape. I'm the guy that I'm the risk taker guy. I mean, to me, if someone says this is a very risky stock, you could lose everything. Hey, that's the one for me.
Hey, and you know what? That's the kind of guy that I want to play against. I want guys like you in the market, Brad, making emotional decisions and saying, "Ooh, I'm gonna put my money in the underdog." That's beautiful because I want to short it because if you don't have a process to assess risk and I'm not belittling you here, Brad. I'm just saying we need people like you to make poor investment decisions and take a lot of risk.
But see, that's why
the rest of us can profit.
That's why I have no money in the market. I have zero money in the market. And people go, how's that possible? I go, I have no money in the market, none whatsoever.
Let me interrupt you, Brad. There's plenty of people, and I can't remember the statistics off the top of my head, but there's a ton of people who don't have a 401k, who don't own stocks. And here's why what's happened in the last month is great for them. Because you're going to be going to, not you, Brad, but some people will be going to the pump who don't own any 401ks. They don't know what the NASDAQ volatility is likely to be today. And they're going to see, because the price of oil has plummeted, and because oil is in what we call quad 4, which is then a depression, they're going to pay less at the pump, and they're going to say, yeah, people are complaining about the stock market, but I'm able to fill up my tank for a lot cheaper.
Okay, John, let me just run this by you. I started off the segment by talking about the fact that gasoline's going down because oil is going way down. Inflation, I heard that inflation right now is like it's zero. Have you heard that?
No, I haven't heard that.
Okay, but you've got all these indicators, and what takes the headlines is, oh my God, look at the stock market, stuff like that. Okay. Aren't there people right now just licking their chops going like, man, there's never been a better time?
Yeah, probably. But the other thing is, and the reason why I don't endorse that wholeheartedly, Brad, is because the idea of just because something is cheap compared to where it was 2 weeks ago doesn't mean it's going to go down. Now, I haven't said this in about 9 months, and I don't want to be one of those guys that tells the same stories over and over again. But I'll repeat a line, Brad, which is that a bargain that remains a bargain is not a bargain. So, and the other mathematical fact, if you look back at any significant market drawdown, is that the market crashes from oversold conditions. Selling begets selling. And especially today, when trading isn't driven by some guy in a pit with a pen in his mouth yelling at a guy selling stocks on the floor, when it's actually driven by computer algorithms, when you have a bunch of people selling, you get more volatility. Hedge funds have to cover their risk, so they sell. You see what I'm saying, Brad?
Yeah.
Just because the quote-unquote stock market is cheaper today than it was 2 weeks ago doesn't mean it's a good value.
I hear what you're saying, John. I really do. And there's a couple different things here. First off, you've got, if you listen to any weekend talk radio, you hear all these guys on there who are pitching these financial things where they say, we've never had a client of ours lose a penny in our investment. And they're essentially selling annuities. You want to explain what an annuity is, John? You're good at this.
Yeah, an annuity would be you give away an asset and you slowly extract the value of that asset over time, which is why on so many old people radio stations you hear, hey, sell us your house. We'll do a reverse mortgage. You'll get money every month. Don't ever worry about money again.
Well, but the annuity, essentially, aren't the annuities mostly run by insurance companies? Isn't that the basis of annuity companies?
Yeah.
And essentially what they're doing is, the idea being is that you put your money in and and what they're doing is they're investing in the stock market as well too, but they're guaranteeing you a payout. They're guaranteeing you that if you put your money into their annuity that you're going to make X amount of money over the course of years and stuff like that. And essentially they're marketing the annuities to people who have very low risk tolerance. Isn't that what that essentially is?
Yeah. And it's the idea of, don't put your money in something risky. Like, choose something safe.
See, I look at this. Maybe I'm just. Oh, I'm not. Maybe I'm just one of these wacko guys that's on the outskirts of sane thinking and stuff. I think to myself, there's sometimes when it's the contrarian who really makes the money. I mean, and I've seen it time and time again. And there's so many issues where the one person who essentially says, everybody's zigging and one guy zags, so to speak, and he's the guy that comes out on top. And to the point where I'm the guy that loves that guy.
You know what? And we've discussed this before too, Brad. Those stories are inspirational. They are rare. I mean, there's a lot of value in being a contrarian. The stories we don't hear are the stories that are people that are contrarians who lose their shirt.
No, I understand.
And nobody writes a story about them. Nobody writes a biography or does a YouTube video for Brad Hildebrand to watch about the guy that was the contrarian and lost his entire life savings and his shirt and his home and probably his family by making a bad contrarian choice. So history selects for the people who were contrarians who made it. What about the contrarians that didn't make it, Brad?
If you know the history of Dave Ramsey, that's Dave Ramsey's story. Dave Ramsey declared bankruptcy. Dave Ramsey lost everything he had because he was a contrarian. He was going the opposite side of there. He was in a zero down real estate group. They were buying real estate for zero down. Now, I will tell you, in my life, at one point in time, and I know this is almost impossible to happen right now. At one point in time, I bought a piece of property, and at the closing table, I got a check. I essentially bought a piece of property with no money down and got a check at the closing table. Back in the day, there was ways you could do this, and that was what Ramsey was doing. The problem on that was that Dave Ramsey was into very speculative real estate, and what happened was when he was at zero down, when the economy went sideways, the bankers called him up one day and said, "Hey, Dave, guess what? That piece of property that you bought for zero down was worth $100,000. Now it's worth $80,000. We need $20,000 from you right now to cover our position because we don't want to be in a negative position on that piece of property." And Dave couldn't come up. I'm just using arbitrary numbers. Dave couldn't come up with the $20,000, so he lost the property. The bank foreclosed on him. Now, the flip side of that is there are guys out there, and to a certain extent, these, all you had to do is listen to radio, turn on the TV. You see all these guys. Hey, you got a house that you inherited? I'll buy your house. And now here's the bizarre thing. Okay, do you know what the standard offer they make is?
No, I don't.
$27,000.
For what?
A piece of property. If you call them up and say,
just a generic piece of property is $27,000.
If you decide you want to sell your house to like the We Buy Ugly Houses guys, they're on the phone. They're going to say, "Well, John, we'll give you $27,000 for your property." And the crazy thing is, I don't know what your piece of property is worth. I would say it's worth much more than $27,000 where you live. But the crazy part of that is some people who are so desperate, once again, motivated sellers. That's what the investors, that's what the flippers and everything look for. Someone who just, I don't want to live here anymore. I mean, I can tell you right now, I know 3 people that if one of these guys walked up to their door and said, "Oh, this house is worth $300,000. And they knocked on the door, "Hi, I'm Joe from We Buy Beautiful Houses and Make Them Ugly. I would like to offer you $50,000 for your house." Deal. Because they just don't want to live there anymore. And to the point where they don't care if they lose money. They just don't want to live there anymore. And the sad part of that is that's why these guys are making money flipping houses. So many times this is the situation. And to me, it's sad. I mean, it's like me in cars. I'm driving around in a car that I paid $300 for, okay? I put 60,000 miles in this car. This car was given up for dead. And matter of fact, the funny part of it is the original owner of this car, I've owned it for 5 years, original owner of this car, I talked to her just last week. And I said, "Hey, I'm still driving your car." And she says, "Really?" I go, "Yeah, it runs great." And you know what? You know how much money I put into this car originally to get it going?
How much, Brad?
Probably about $400. I mean,
wow.
and to the point where I mean, I've told the story. I can go to Pick and Pull down on Hall Street. I can say, I can drive that car out, I can drive that car out, I can drive that car out.
Yeah, I know.
Because people are to the point where, well, you need a new air conditioning compressor. Well, I'm just going to get rid of that car. Well, an air conditioning compressor is $800. I don't care. I'm just going to get rid of it. I'm going to buy a new one.
Brad, I do off the air. I do need a lawnmower. If you have a guy that can work on lawnmowers, I do have a lawnmower question for you. I don't mean to derail your Brad's greatest hits here, but I do need a lawnmower guy.
Do you really seriously need a lawnmower?
Yeah, I really do. I'm having trouble getting a strip bolt out of my blade.
Getting a what?
I have a bolt that's stripped. I don't think we need to waste time on the air with this, but we talk about it off the air.
John, can I tell you something?
Yep.
Just buy a new one.
Oh, really?
Yeah. Or here, if you really want my advice, go on Facebook Marketplace, and there's all sorts of people giving away. I've got a lawnmower right now that I would give you. It doesn't run, but if you said to me, John, Brad, no, seriously, I got a lawnmower that probably has 15 hours on that was given to me by somebody. And the problem with it was they didn't use it for like 4 or 5 years. I guarantee I know what the problem is. The carburetor's all gummed up because
that's what happens, especially if you don't drain it, right?
Right. I could pop a new carburetor in there. I could probably find it on Amazon for $20-$30. I could put that on there. Matter of fact, that's going to be my project. I'm going to fix that this weekend. I'm going to give it to you. How's that, John? It's a pretty nice lawnmower.
We can talk about that off the air. I appreciate the offer.
See, you come to the right guy. Now, here's what I would say, and you're not going to like my advice. Don't buy consumer crap. Go buy yourself a commercial lawnmower, and you will have that.
You told me that. I appreciate that advice, Brad.
For the next 40 years. That lawnmower will never wear out on you because those are designed for guys who are using them every single day, 8 hours a day. If you use your lawnmower 1 hour a week, it will last you forever. And I'm telling you, that's the way to do it. But that's a whole other story. Okay, we have to take a break.